and welcome. In this video, we'll explore the key points of Module 3 on financing for clean energy transition projects, with a focus on small European municipalities. We'll cover the reasons we need financing, important economic terms, and the variety of financing pathways, including both traditional options and specialized European Union programs. Whether you work in a local authority, a private company, or a community group, this overview will help you understand how to plan and fund sustainable energy projects effectively. By the end of this training, you will have a better understanding of key financing options and common terminology, different ways to fund projects using internal cash, loans or bonds, and leasing, performance contracting concepts, contract structures, benefits and risks, plus measurement and verification terminology. You will also be able to evaluate and select the most suitable type of financing for a given project, identify and pursue the appropriate financing programs for additional support. So, why is financing essential? Even the best clean energy ideas need financing to bring them to life. There are multiple key reasons why financing is important. The first reason is planning and preparation. You often need funds early to cover engineering, consultancy, or feasibility studies. The second one is upfront investments. Capital expenditures are required to purchase equipment, install technology, or construct facilities. And the final one is operational costs. Operation and maintenance expenses must be covered to keep systems running smoothly. If your project can generate revenue or savings through energy sales or efficiency gains, then these benefits can help repay any money borrowed. But ensuring the right financing structure is key so that these projects are sustainable for both the environment and the bottom line. Economic analysis and key terminology. Before diving into the different financing options, it's important to understand a few basic economic terms. First, present value, the current worth of a future sum of money. If you expect to receive 10,000 euros in 5 years, its present value today is lower because the money has a time value. Discount rate. This is the interest rate used to find the present value of future cash flows. A higher discount rate makes future cash flows less valuable in today's terms. Net present value, or NPV, the difference between the present value of benefits, like energy savings, and the present value of costs, like equipment purchases. If your project's NPV is positive, it generally means the project is financially viable. Internal rate of return, the discount rate at which a project's NPV becomes zero. If the internal rate of return is above your organization's required minimum return, often called the hurdle rate, the project is financially attractive. Life cycle cost, the total cost of owning and operating an asset, from purchase through disposal, all expressed in present value terms. This helps compare alternatives, for example, a petrol or diesel-fueled car versus an electric vehicle, on the basis of total cost, not just the initial purchase price. Understanding these terms allows you to decide if a project is worthwhile and to prioritize among multiple opportunities. Traditional financing options. Let's look at 3 common ways to finance a project. The first way is utilizing your own resources, or cash on hand. If you have enough internal funds, this is the simplest route. There's no external approval process, and you won't pay interest. However, your internal budget may be limited, and using your own resources might mean delaying or skipping other projects. The second is loans and bonds. Borrowing is similar to taking out a mortgage. You get the money up front and pay it back over time with interest. A loan is usually from a single financial entity. Bonds effectively let you borrow from multiple lenders in the financial market. What is the difference between project finance and corporate finance? In project finance, the project itself is the collateral. If loan payments fail, the lender can take ownership of the project assets. In corporate finance, the organization's overall assets guarantee the loan. The third way of financing a project is leasing. Here, you have an operating lease, or a true lease, where you rent the equipment. The rental payments are deductible, and you typically don't keep the asset at the end. And you also have a capital lease, or financial lease, which is similar to a loan. You usually have a buyout option at the end of the lease. You can often claim depreciation benefits and interest deductions. Financing rates. Interest rates depend on your creditworthiness, the contract structure, and your project's perceived risk. A key point: if your organization's hurdle rate is high, using a loan at a lower interest rate can improve your project's net present value. Performance contracting and energy service companies. Another way to finance projects, especially for energy efficiency, is through performance contracting with an energy service company, or ESCO. Here's how it works. The ESCO identifies, installs, and maintains your energy-saving project. Financing often comes from third parties, but the ESCO guarantees that your savings will be enough to cover the loan payments. Shared savings contract. Both you and the ESCO share the verified cost savings. Guaranteed savings contract. The ESCO pledges a minimum amount of savings. If actual savings exceed that, then you keep the extra. Why consider an energy service company? They bring technical expertise in implementing efficiency measures. Projects can be structured so that you have little or no net cost as the utility savings offset the financing repayments. Particularly popular in public buildings, where the ESCO's risk is lower because local authorities are stable, long-term partners. European Union financing programs. The European Union provides a range of funding programs in the form of grants, subsidies, loans at special rates, and guarantees. These programs can significantly lower your cost of capital and make clean energy projects more viable. The first option is Horizon Europe. With an indicative budget of over 90 billion euros, Horizon Europe focuses on research and innovation. If your project pushes technology boundaries or addresses scientific gaps, it's worth exploring calls under Horizon Europe. The second option is LIFE program. This specifically supports projects in environment and climate action. The sub-program, Clean Energy Transition, is of special interest for municipalities seeking to increase renewable energy and improve efficiency. The third possibility is Just Transition Mechanism. Part of the European Green Deal, it ensures no region is left behind. It includes the Just Transition Fund, with around 17.5 billion euros for the period of 2021 to 2027, aiming to help regions heavily reliant on carbon-intensive industries shift towards climate-neutral economies. The public sector loan facility under the Just Transition Mechanism provides preferential loans to public entities for projects in these transitioning regions. And finally, shared management funds. The EU also works with national and regional authorities to deploy European Regional Development Fund, Cohesion Fund, European Social Fund Plus, and more. These can co-finance energy and climate projects. National and regional financing programs. Beyond EU-wide options, it's essential to check your national and regional programs. Many countries have subsidies or rebates to encourage energy efficiency or renewable installations, tax incentives or feed-in tariffs for solar and wind projects, and dedicated loan facilities for local authorities. Make sure to explore these avenues. Some might offer faster application processes or higher success rates than large, competitive EU grants. Putting it all together. To finance your clean energy project effectively, start with economic analysis. Calculate net present value, internal rate of return, or life cycle cost to ensure the project stands on solid financial ground. Then select a financing structure. Decide if it's best to use your organization's funds, take a loan, issue bonds, lease equipment, or partner with an energy service company. Explore available EU and national programs. Identify grants, guarantees, or co-financing that can significantly lower your project's costs. Implement and monitor. Carefully track your project's performance to ensure you meet financial and environmental targets. Remember, the goal is to create a positive outcome for the environment and your community's finances. With the right approach, clean energy investments can pay for themselves over time and even generate revenue or savings. Thank you for joining us for this overview on financing. We've covered the fundamentals of economic analysis, a range of financing options, and key EU programs. As you plan your project, remember to engage stakeholders early, especially lenders, energy service companies, and policymakers. Use tools like net present value, internal rate of return, and life cycle cost to prioritize the most cost-effective projects, and take advantage of EU-level and national funding instruments where possible. By combining smart financial planning with robust technical solutions, we can accelerate the clean energy transition in municipalities across Europe and beyond. Good luck with your projects, and thanks for watching.